Welcome, everyone. My name is Aaron Philbeck. I'm the Associate Director of Content Development at Kai Association. I'm joined by Chris Hamilton of Invesco Investment Solutions, and today we're going to be walking through a presentation titled Insights into Institutional Allocations. This is the first of two parts where we will be walking through some insights that Chris has. And I'm going to turn it over to Chris to introduce himself and give us a high-level view of the agenda that we're going to be walking through today. Chris?
Hey, Aaron, thanks a lot. Thanks for having me today. Like you mentioned, I'm Chris Hamilton. I'm head of Asia ex-Japan Client Solutions for Invesco Investment Solutions. Looking forward to having a conversation today. We'll cover a few topics. We're going to cover, what we consider an overview of the alt space, mainly within the construct of a multi-asset portfolio. So kind of looking at all the assets that would go into a portfolio, kind of how we're viewing market opportunities going forward, how alternatives fit into that. The next piece is going to be some insights we've gleaned and working with a few hundred institutional clients the world over the last few years, how clients in different parts of the world think about allocating to alternative investments, how they view alternative investments as fits in their portfolio, and most importantly, how we think that's going to shift over time, because institutions, depending on the particular type of institution or where perhaps they're domiciled, are kind of in different spots with respect to how they're implementing alts and how they're thinking about alts as a way to increase the likelihood that they're going to achieve their investment outcomes. And then the third piece, which will actually be a second subsequent discussion, will be alts implementation. So this is really where we dive into how we think about implementing alts in a portfolio. We get our hands very dirty. We dive into some of the tools and resources that we use on our end, primarily what's called our Invesco Vision tool, to go in and understand where alts fit, how they increase the likelihood of our clients achieving their investment outcomes, and most importantly, how do you think about alts at an asset allocation level? Oftentimes, we're very focused on manager selection when it comes to alts, what managers make the most sense, which managers have a tendency to do best in their particular categories, but really kind of the initial step before that. Thinking about alts at an asset allocation level, just like you would with equities, fixed income, and the tools and resources and research we've done to be able to do that. So the first page here is really, the first slide in any presentation that I show. A client, I think it's pretty easy to look up and see what markets have done on a trailing basis. And really all we're trying to show you here is we think that the market going forward, public markets in particular, because if you look at the asset classes on this page, it's all going to be public bonds and equities, lower returns and higher risk going forward. If I were to kind of summarize the next 10 years, this looked a little bit more stark in terms of the difference at the end of the year. Everything that's happened in Q1 with all the volatility in markets has changed that a little bit. But I'd say even with all that, we do see lower returns and higher risks for public markets going forward. So if you're a pension plan and you have a particular return target you have to hit, somewhere between 6 and 7%, a traditional 60-40 model, we don't think is necessarily going to get you there. So you're going to have to do a couple of different things. You're going to have to change the risk tolerance of the portfolio to be able to do that and increase your risk both on an absolute level and a relative level, relative to your liability streams, or you have to start thinking about different asset classes. And alternatives are really like our first stopping point for thinking about how to increase returns in a portfolio without really assuming meaningful levels of risk. So it's very important to balance both of those, but we think this is a clear fairway opening for alternative asset classes. So the next page here really starts to effectuate some of that. So, you look at some various asset classes here in terms of their historical returns and where we think they sit going forward. And you're going to notice that we actually see alternatives as a more attractive asset class going forward than what we've seen over the last 10 years. In public equities, it's almost the reverse. In fixed income, it's a bit mixed. And you can really see, at least according to our market views, take them for what you will, that there are some opportunities in the alt space going forward. And if you look at the graph the metric on the right-hand side of the page, we juxtapose that 4.5% return for a 60-40 portfolio of public markets and a 10% risk. And one line above that, you see a similar portfolio with a sizable implementation to alts there, where you're able to do two things. You're able to increase the return of the portfolio, and you're actually able to reduce the risk over a full market cycle. So this is what we would call increasing your likelihood of achieving your investment outcome, whether it's a pension payment, whether you're an endowment or a foundation, whether you're a private investor who has investment objectives that you need to hit, and really thinking about alts as a fine-tuning vehicle. This breaks out the alt space a little bit more. We were aligning alts with public market asset classes before. What we're trying to do here is just break them out. So, I mean, you see, what we'd consider pretty strong opportunities in alts going forward. I think it's really important to emphasize the aspect of going forward. So we're not looking at historical returns here. What we try to do is we try to generate capital market assumptions for alternative asset classes to give us a forward-looking barometer as how we should think about opportunities in that space, similar to how we would with bonds, similar to how we would with stocks. So this is a little bit different. I do think one thing that's unique about what we bring to the table is our coverage with the research we do on capital market assumptions. So we look at 175 asset classes across 20 currencies for opportunities. And alts is a big component of that. So you can see here, what we're trying to do is generate a forward-looking view on alternative asset classes and then build a portfolio going forward that we think is going to increase an investor's likelihood that they're going to meet their investment outcomes, and really standardizing everything on, what we'd call an apples-to-apples basis. I mean, there's this whole idea of smooth returns in alternatives, something that public markets don't necessarily have the advantage of. So what we try to do is strip all that down and calculate returns on an apples-to-apples basis for all asset classes to give every asset class an even starting point. And then from there, build a portfolio that's centered around either a target risk or a target return for a client. It can mix depending on the client archetype you're working with, but really using an all-the-above approach to asset allocation. And that's really what I think the theme of the next 10 years is going to be, an all-the-above approach to asset allocation and portfolio construction. Over the last 10 years, really a 60-40 portfolio of domestic U.S. stocks and domestic U.S. bonds really did the job. We don't think that's going to be the case going forward. We think markets are going to be more complex. We think volatility across the board is going to be higher, and you're just going to have more tools at your disposal to achieve the objectives you want to achieve. We think to do that soundly and to do that effectively, you have to have a research infrastructure and apparatus to be able to guide you towards making the right decision. And like with anything in portfolio construction, it's really not a what-if question. It's really a how much question. And that really makes sense and really resonates when it comes to alternative asset classes. We are dealing with something a little bit different than stocks and bonds. So having a research mechanism there to be able to point you in the right direction is really important. And this is before we ever get to manager selection, picking an individual underlying manager that we think makes sense for portfolio. We think all this front-end research needs to go into it, and you need to have an idea of how much you want to allocate to alts and how much you want to allocate to the sub-asset classes before you even get to that stage.
And Chris, we can see the numbers here as you're going through here and looking forward. Maybe talk a little bit more qualitatively about some of the conversations that you've had with some of these institutional investors. I know we look at some of the return projections. You mentioned 6.5 to 7%. Historically, I guess over the past couple of years, those return expectations haven't been hit for many institutions. What are those conversations like? And maybe talk a little bit about those allocation decisions. And I can see here on the page, return expectations for some of these alts are pretty attractive. So balancing going all in on maybe some of these alts with some of the traditional, and I guess talk about some of those conversations.
Definitely. So when we're sitting down and having a conversation with a client, this has evolved over the years. It's become now very outcome oriented, particularly as equity markets have done really, really well. And funding ratios for pension plans have still declined because the liabilities are very much driven by benchmark interest rates, which have declined. At this point, to negative rates outside of the US and very, very low rates in the US. So, you have someone who's managing a plan or investing on behalf of a plan, and they're looking at their funding ratio saying, wow, I'm at 74, 75%. The market's at an all-time high. How do I want to think about that from an outcomes perspective? And that's before we had what happened in Q1. So those funding ratios have declined across the board. And when you think about that, that's really where they're looking for partners, whether they be asset managers or other different providers in the field, who can help them think through the right level of alternatives to implement into a portfolio, and what alternative sub-asset classes do they want to use, and which of those sub-asset classes is going to help them effectuate their investment process and achieve their investment goals. Like what you alluded to, is mainly in the form of a return target. Sometimes those return targets can be moved, but most of the time when you're dealing with a pension plan who has obligated payouts they have to make to plan participants, there isn't as much flexibility there as you would think. So the first natural stop is, okay, how do I take a more all the above approach to asset allocation and portfolio construction first, maybe before you start thinking about that? And that's really where it can vary. And there are a lot of nuances from different plan archetype to different plan archetype, or if you're dealing with endowments and foundations, they're very, very comfortable with alternative assets. It's something they've been doing for a while. It's why they call it the endowment model. But when you start to get into the pension space, it can get a little bit different. And we've got some metrics in subsequent slides, but it can really start to vary. Maybe you're looking at a plan that has 10% exposure to alternatives, and it's primarily real estate. Maybe it's even less than that. Maybe they're looking at real estate and maybe a mix of private equity, and really trying to get them to expand their view of the alts asset class to be able to effectuate an outcome. And that's really all we're trying to do. Is we're really trying to help them accomplish a mission, which is hitting a predefined return target that we now think going to be more complicated due to various factors affecting equity markets. But like you said earlier, you can't necessarily allocate 60, 70, 80% of a plan assets to alts, particularly if you're a pension plan. You have a lot of cash going out every year. So we typically think about portfolios through a factor framework. So ultimately getting beyond an asset class view and stripping a portfolio down to a series of macro factors, and those macro factors are going to drive volatility in a portfolio. And one of those macro factors is going to be illiquidity. We do think illiquidity harvests a premium over a full market cycle. However, there have been periods of time, think about 08, 09, other periods, maybe this will come to fruition sometime this year. We just haven't seen it yet because what we've been going through has lasted, much shorter in terms of duration, particularly when you compare it to the GFC. Is lack of liquidity can hurt you. And if you're making out constant payments to pensioners, that really is the balancing act, right? How do you think about implementing all thoughtfully, but allowing yourself enough liquidity in your portfolio to be able to meet your pension plan liability? So it's a bit of a push and a pull. And like I mentioned earlier, clients are coming to us with that how much question. They know they need to increase their allocation to alt. The question is how much into what sub-asset classes. And they typically just don't have the research on capital market assumptions in terms of the coverage or the analytics. They have great manager selection processes. They have a lot of relationships with managers, and they just want help and partner with someone who can put all the pieces together.
Great. Well, Chris, let's go to the next slide here. And I think that this chart is very interesting and something that we've certainly paid a lot of attention to from a growth standpoint. Maybe quickly walk through this slide and specifically talk about, I guess, again, more qualitatively, what you've noticed in terms of how the industry has changed, matured, evolved over this time period.
Definitely. So if you think about the pie chart on the left, you think about the pie chart on the right, the one thing that stands out to me is the growth in the number of sub-asset classes. And this evolution past large cap PE, VC, and real estate into something that is multiple stages of VC, multiple classes of private debt, multiple classes of real estate. And as the opportunities have grown, one of the side effects of that can be inertia, because if you're allocating to these assets and you're managing a plan, how do you think about effectively deploying to these sub-asset classes, similar to how we thought about public equities 20, 30, 40 years ago, where, you know, a portfolio was large cap stocks, and then we had treasury bonds, and you kind of kept adding asset classes to the mix. And then we started investing outside of the US, and we went into EM and all these asset classes and liquid fixed income. The same things happened in alts. And really, we think a similar approach is warranted, where you need to have a firm understanding of go forward returns with these sub asset classes, and you need to be able to accurately categorize risk and what macro factors are driving risk in those sub asset classes, and really rolling everything up and understanding, okay, where are my exposures coming from? What are my return drivers? And is that at the end of the day going to help me achieve my investment objective? So you see more choice. With more choice often comes, you know, more confusion. So that how do I do it question becomes really, really important. I mean, you've seen the AUM go up. I think that's pretty, you know, evident to anybody who's participating in the industry. But the piece that I think is really worth hammering home is just the amount of, you know, alternative sub-asset classes that are available that warrant. You can do specialty finance, you can do aircraft leases, all this. How do you think about rolling this up to a portfolio level? Because at a micro level, they all sound really interesting. Oh, this is an interesting opportunity. You know, maybe it's a diversified source of alpha, but you can be the best manager in a particular space and not make sense for the portfolio. Those don't necessarily have to coexist. And I think maybe before we always assume, well, if something really looks good in its category, I should really think about adding it to my portfolio. In this environment now where you have underfunded pension plans and achieving outcomes is going to be harder, taking a portfolio level view, you know, in our opinion, is going to be more essential than ever before you even get to selecting a manager.
Great. Why don't you take the next couple of slides and just kind of walk us through how you think about this, a framework for implementing alternatives, and maybe just more broadly a framework for implementing a portfolio. I think, you know, the next couple of slides really hammer home some of the ways that you more philosophically think about this.
Absolutely. And you see the slide right here, and we're framing it with respect to alternatives. However, I would say this applies to asset classes across the board, both private and liquid. We'd call these the atoms of investment objectives, of investment goals, and really everything else builds on top of that. And as complicated as we like to frame, you know, how our jobs are and how our industry is, at the end of the day, we think investment objectives roll down to three: growth, income, and diversification. And if you're talking to a client, most of the times when they're conveying their needs and they're conveying their concerns about their portfolio, they can typically fall into these three buckets. And usually the end objective they're trying to achieve is some kind of amalgamation of these three objectives. So if you're a pension plan and you're 75% funded, growth is going to be one of the primary outcomes that you're looking to achieve. You need to achieve growth because you don't have the level of assets to meet your level of liabilities at a future date. If you think about individuals and you think about the private management space, with all the baby boomers retiring and you know, continuing to go into retirement every day, income is very, very important for them because they have spending targets they have to hit. They have various needs they need to meet. And income is the primary way those individuals think about it. So when they're thinking about their primary investment objective, usually it's income first. Diversification is an interesting one because I think diversification can manifest itself in very different ways. If you think about you know, an investor who has a need for growth in, you know, what was a late cycle environment, how do you think about injecting growth in a portfolio without injecting a lot of economic risk into your portfolio, economic growth risk into your portfolio? And I think that's where private market investments can become really, really interesting because you can have the growth you need, but still add diversification. If you think about that second investor archetype where you need income, typically the secondary objective is some kind of capital preservation, because if you're a retiree and your pool of assets is not going to grow through your own earnings, you don't want to lose what's there. So you don't want to take a lot of risk and, you know, in the process of generating your income, which is why if you need income, you wouldn't just buy all high yield, or you wouldn't buy all bank loans or something like that, because you juice your yield, but at the same time, you'd leave yourself open to a lot of risk. as we saw in Q1 and into Q2. So diversification is interesting because it comes into play for both of those types of investors. Seldom do you run into an investor who diversification is their absolute first investment objective. Usually it's income, usually it's growth, and diversification is somewhere behind that. And alts is the same way. So you categorize alts into any three of those baskets. And what's nice about alts is alts are usually going to have aspects of all three. You don't really see that as much with public market investments. And that's why they're such a great tool from a portfolio construction perspective and just viewing it through the lens of achieving investment outcomes.
Let's get into implementation a little bit. Walk us through this the schematic that you have here and what are that people should know.
Absolutely. And this is really what I'd call, a top-down schematic to thinking through the question of how do we want to implement alts and how can alts benefit our portfolio. And we've talked about this in prior conversations before this call. We have a tendency to view alts in this basket that we don't view public market investments in, where it has a tendency to be this bottom-up approach, where you talk to a manager, the strategy sounds really interesting, they generate a lot of outperformance, and great, let's put it in a portfolio. But typically, we don't think about other asset classes that way. When we think about equities, we want to take a view on what we find is attractive in the equity markets, whether it's regions, whether it's sectors, whether it's factors, and then allocate downward. What we're advocating for is using the exact same approach for alternatives. And it really starts with identifying your investment objectives. So really just an extension of that prior slide we just looked at. What is important to you as an investor? Is it growth? Is it income? Where does diversification come into that? And when you have that conversation with the client, you can really build a customized plan for them to help them effectuate that. And then everything cascades downward from there. The second piece is defining risk allocation. And all that is just following up on that, comment I made a few minutes ago about why don't you just put all of your portfolio in alts? Well, if you're an endowment and you're meant to have an infinite life and you have the spending policy of 5%, you can allocate more to alternatives. The reason they call it the endowment model is because all endowments use it. But why do endowments use it? Because it makes sense for them, because they don't have the liquidity needs that a pension plan does. So it's understanding what kind of liquidity needs your fund has and what kind of tolerance for liquidity that you have in your portfolio is really going to define the risk allocation between public markets and private markets. Now, when you're allocating the sub-asset classes between there, it's a bit more nuanced, but that's kind of the first thing I think about. How important is liquidity to you when you're building your portfolio, whether it be for financial reasons like a pension plan, or maybe behavioral reasons, like in the private wealth management space, where a lot of times there are what I'd call financial considerations, and then there are behavioral considerations which really come into play. Some people just aren't comfortable locking up a big sum of their money for a meaningful period of time. They want to have access to it. And when you're having a conversation about alts in the private wealth space, one of the first questions that comes up is liquidity. When can I access my money when I need it? When you're having a conversation with an institution that doesn't really come up as much, or if it comes up somewhat down the road. Maybe they just kind of know the rules of the game a little bit more than they do in the private wealth space, but liquidity from a behavioral perspective is going to be more important. Moving to the third piece is really the refinement. So that's really where we go into the research, the capital market assumptions, and understanding what alternative sub-asset classes are going to point the portfolio in the direction we want to go. And all this comes into play before we even think about analyzing a manager. And I think it really just kind of the theme of this whole conversation is having a front-end process and a top-down process for thinking about and identifying opportunities in the alternative space, is something we think is going to be really important going forward.
Now on this slide, and I think some of this plays into what you've just discussed. So, I'd love for you to walk through this, but I specifically, when you get to the manager selection piece, I'd love to have a little bit more of a detailed discussion on how you think about that, and specifically manager dispersion. So, you can take a top-down view of allocating a portfolio, but you look especially in the alt space relative to traditional asset classes, and you could drive a truck through some of those dispersion numbers. So I guess walk through this, but I specifically want to focus on the manager side of things too.
Absolutely. So the pieces that are really going to be unique to alts are going to be manager selection, portfolio construction, and then risk reporting. The front end sections or the front end parts of what are our 5-step investment process. If a client comes to us, Invesco Investment Solutions, and says, I want you to build me a customized mandate, they're going to go through this framework, whether they're using private markets or not. So we use a universally applicable framework to all asset classes. We start with comprehensive research. That's going to be capital market assumptions, understanding the client investment objective, having that back and forth dialogue. We don't approach clients with package strategies and say, hey, this is an interesting strategy. It's outperformed. You should think about it. We start every dialogue with a series of questions. We want to firmly understand what our clients are looking to accomplish. The second piece is asset allocation. So how do you make those capital market assumptions align with the investment objectives that clients have laid out? So that's a universal conversation, whether alternatives/private markets are involved or not. The third piece is really where it starts to get important, particularly for the alt space, and you allude to this aspect of manager dispersion in the manager selection space. So this is really where manager selection becomes very, very important, because the variability of outcome and the variability around a peer group or a benchmark is extremely wide in the alt space. So you want to be sure and think through that. You want to look at a manager's. You want to look at things like track record, process, philosophy, performance. But at the end of the day, if a manager comes to you and says, yeah, we have a tendency to hit 600-foot home runs and we have a tendency to strike out, that might be attractive for some investors, and it might not be attractive for others. If you're a pension plan who can't accept a lot of variability around a liability target, even though in the absolute that manager might have performed really, really well over time, and their average performance is in line with other managers in their peer group, you want to be able to think about that and really think about it through more of an outcome-oriented lens. Now, this is where portfolio construction becomes really important. Because of that variability and that dispersion around returns, you're going to have different kinds of risk exposures driving those returns for the underlying strategy. So you can't just boil it all down to one singular return number. It becomes really important for how they got there and how are they going to continue to get there. So really that's where the risk management and modeling becomes really, really important for us. Like I said, we use one of our platforms for managing risk. It's called Invesco Vision. There are other platforms out there as well. I'd implore investors to think about using a platform that can break down risk down to an asset class level, down to a factor level, and really making sure that the portfolio you have built aligns with the asset allocation model and has the same risks, or directionally the same risks as the asset allocation model. Because in the alt space, different private equity managers are investing in different opportunities. Same thing in the private credit space. So you want to know what macro factors are driving value there, and then what level of idiosyncratic exposure you're getting. If you're buying an alt and 90+% of the risks are coming from factors, it's going to be cheaper just to implement that portfolio using factors than paying an active manager. So you want to make sure you understand how much idiosyncratic risk is coming into the portfolio. And that's another advantage to alts in general, is you do get more idiosyncratic exposure. More and more in the public market space, what you're getting in idiosyncratic is pretty small in most of its factors. So if you're going to allocate fee budget to your portfolio, you want to allocate it where you're getting the air quotes, manager special sauce, or something that the manager has access to, or the ability to analyze that other managers don't. And that's really where the portfolio construction piece is important. You want to make sure everything aligns to the model you built out at the very beginning. And then kind of the risk and performance monitoring, really more so risk monitoring, understanding what risks are driving variability in your portfolio through a common framework. We like to use factors. We think they make the most sense, and how that changes over time. How to manage your exposures change, how do approaches and processes change. And really it's an ongoing exercise to make sure if the underlying macro factors we're looking at in a portfolio shift, it's not going to point us in a different direction away from our desired investment outcomes. Because the underlying managers might be performing well, but if we don't think over time their process is giving us what we want at a portfolio level, it might make sense to kind of think beyond that or think to the next opportunity. So really just having tools and resources that have the ability to analyze and thoroughly be able to understand alternatives as an asset class and understand where we think they're going to go going forward is really an essential component of that. And it's just more complicated to do. With public market investments, we're able to scrape the underlying holdings. They're posted every day or every month. It's very evident and obvious what a fund owns. In the alt space, it is much, much more complicated. So you're doing things like developing proxies and things along those lines, and how good can you develop proxies? And that really comes into play in that space. So you just have to have a completely extra layer of due diligence.
Now, I know everyone here watching this has seen an efficient frontier before. So maybe talk through how you think about building an efficient frontier for a portfolio that includes alts, because when you're including an alternative allocation, you've got things such as smoothing, you've got fat tails, skewness, kurtosis, some of these things that may violate the original principles of an efficient frontier. How do you think about that? And I guess, how do you build out an efficient frontier for an institution with those things in mind?
That's a great question. So I'll kind of tackle your two key issues there, which are return smoothing and then fat tails. So from a return smoothing perspective, and I think I mentioned this, in prior comments, we do de-smooth returns for alternative asset classes, because what we're doing is we're making a decision between all asset classes. So we want to put everything on an equal playing field. I mean, there is historical evidence, that risk can be dampered by semi-annual or quarterly valuations versus public markets, which are valued every day. So we have a process for de-smoothing risk. So we want to put everything on an equal playing field and then make a decision from there. We don't want to have biases in our analytical process that unfairly advantage a particular asset class that are then going to cause us to overweight an asset class. And then when volatility does hit, usually when a client needs liquidity and they're trying to get out of a position, some of those risks can manifest themselves that weren't evident if you didn't partake in that de-smoothing process. And then the second piece, the second piece there is understanding fat tails. So in terms of looking at public market investments, particularly equities, you do have the advantage of a fairly normally distributed stream of returns. So traditionally, an efficient frontier is constructed, and you pick a portfolio through some kind of mean variance optimization process. You're trying to maximize return per unit of risk over some kind of long time period. The issue with alts is alts don't have normally distributed return streams. So some alts asset classes, you're more likely to lose large sums than make large sums. So because of that, you have to add a lot of tweaks to your optimization process to be able to make a sound investment decision. That's really, really important if you're injecting and incorporating alts into your portfolio. And you have to think beyond just doing an optimization. You can do an optimization, but ultimately you need the ability to do stress tests, because stress tests in particular periods of time are going to tease out biases in a portfolio that don't necessarily show over a full market cycle. So it's about thinking about a portfolio both through and within a cycle, and thinking about that as you're building out your allocation. And that really can show you and can show the client, okay, this could potentially happen in your portfolio, and it's a better indication of how much risk is really there. Because people don't really think about risk over a full market cycle, even though they have a tendency to focus on the standard deviation number over a full market cycle. What they have a tendency to worry about is risk in a time like what we're living through right now, or risk in the global financial crisis, or risk in the tech bust. They're not thinking about it over a long period of time, even though they have a tendency to obsess over that long-term volatility number. So because of that, doing a lot of stress tests and having an analytical platform to be able to show them, okay, your positions in alts could go down by this much on paper. Are you okay with that? Like I said, some people can, some people don't have the behavioral ability to be able to digest that, and they'll act adversely. So you want to make sure you can prevent that and stop some of that stuff in advance, and just have a wider framework for analyzing both the benefits and the costs of owning an alts position.
Great. I want to talk a little bit about factors, and we can wrap up for part one before we get into part two, but just talk a little bit about factor exposure in alts and maybe some of the common factor exposures that you see across some of the different asset classes and industries.
Absolutely. So when breaking down any portfolio, we think factors are the ideal way to view and understand how portfolio risks are driven. We'd call factors the atoms of portfolio construction. Asset classes are really more like molecules. So we want to break portfolios down to the most granular level possible and understanding what our big risk drivers are. So we're going to look at common macro factors no matter what positions we hold in a portfolio. how much of our portfolio is being driven by equity, how much of it's being driven by rates, inflation, things like that, and how much of it's being driven by these alternative macro factors. And looking at retail portfolios versus institutional portfolios, you can really see the difference. In a retail or a private wealth portfolio, roughly 90% of a portfolio's risk is going to come from equity factors, global beta, things like that. Something that's really levered to economic growth. When you go to the institutional space, there is dispersion, but on average, a lower percentage of the portfolio risk is driven by equity, and a higher percentage of portfolio risk is driven by alts. So it's really going to a client and saying, how much economic growth risk do you want in your portfolio? How much global beta do you want in your portfolio? And do you want growth without having the economic growth risk and completely levering yourself to what happens in the macroeconomic backdrop? And I think that creates a natural opening for alternatives. And most public market investments you look at have little to no alts exposure or alts macro factor exposure. Even funds that are classified as alts don't have much alts macro factor exposure. Like I could pull a REIT fund and put a REIT fund in here, and it doesn't have any real estate exposure. It's all going to show up as public market equity. So when someone comes to you and says, well, I'd rather implement it through a public framework, I like the liquidity aspect, it's really being able to articulate the trade-offs you're making, because you're not getting the macro factor exposure you think, and you're going to be more levered to economic growth.
Great. Well, Chris, this has been a great first part of this discussion. In the second part, we're going to be getting into some views of institutions globally, and I think you're going to compare and contrast what you see across different institutions, and then get into some fun stuff, some case studies, walking through a hypothetical portfolio, and maybe what are some of the things that you might want to think about if you were ever presented with something like this. So thank you so much, and we'll see all of you on the second part of this.
Thank you very much, Aaron.